This Week in Startups is brought to you by Weebly. Whether you're looking to create a side hustle or your dream job, Weebly can help you get there. Visit Weebly.com/twist for 15% off your first purchase. And LinkedIn. LinkedIn has marketing tools to help you target your customers with precision. For a free $100 LinkedIn ad credit to launch your first campaign, go to linkedin.com/thisweekinstartups.
Hey everybody, welcome to another episode of This Week in Startups. This is the show where twice a week we talk about technology, startups, and entrepreneurship with operators of companies, investors in companies, and authors and journalists. Today on the program, we have triple threat Randy Komisar, who was an operator and worked for George Lucas at LucasArt, TiVo, if you remember that company, and Web TV before it, a very famous company that Microsoft bought. And he's been a venture capitalist for a couple of decades at Kleiner Perkins, which you know. And he's also the author of a couple of books. I effing love that company, The Monk and the Riddle. And also Getting to Plan B, Breaking Through the Better Business Model. But his latest book, by HarperCollins Business, is Straight Talk for Startups. The book is amazing. I've been listening to it, and Randy reads it himself like all true authors do. And the book goes over the 100 insider rules for beating the odds, from mastering the fundamentals to selecting investors, fundraising, managing boards, and achieving liquidity. It's been a long time coming, but welcome to This Week in Startups.
Thanks so much for having me, Jason.
For people who don't know, how would you describe yourself? Because you've been an author, you've been a venture capitalist, and obviously CEO, virtual CEO. How do you describe your career?
I always still consider myself an entrepreneur, first and foremost. Even as an investor, even as an author, I consider myself an entrepreneur.
Why is that?
Because I view all these things as creative mediums, right? Mm-hmm. Whether I'm an investor or whether I'm an author, I see myself as creating something with others in collaboration, which is the art form.
Why did you make the jump from being an operator to being an investor? What was part of that mindset? Was it the money, the power, the glory, or were you just exhausted from operating businesses? Because it's always interesting to see how people got to venture capital. How did you get to venture capital?
Well, there was a half step that was really important, and that was called becoming a virtual CEO. After I left, when I came to Web TV, after I left Lucas, I took a role with Steve Perlman in building that company, which was not the CEO role. I didn't want the CEO role. I was doing some soul searching about whether or not I felt like being a CEO was the right place for me in this ecosystem. And he gave me an opportunity to be sort of this avuncular, experienced advisor, mentor, coach, and called me virtual CEO.
Got it.
Very involved every day. I was in the office. I was in meetings. I was taking on, sort of fires to put out. But I was supporting him. I was not displacing him. Right. And that role became sort of my venture management role for about a decade. And so I came into venture capital from that role, and I didn't do it. I wasn't enthusiastic to do it. I went there because John Doerr was doing something at Kleiner that I felt I couldn't do on my own, and that was to take on big, global, hairy, audacious problems like climate change. Right. And I felt like Kleiner was a platform for doing that, and I was never going to have that again.
And so this is in the 2000 timeframe, 2005, or I'm trying to remember when you started, but it was
2005 was
2005
when I finally got there.
Which is ironic and paradoxical because I actually pitched you. Not to make it about me, but we had this great meeting where I was doing Mahalo.com, which became Inside, and I had a term sheet from Sequoia, Mark Cuban, and then you guys actually offered to fund, but you wanted to do it in stages.
Yes.
But I told the story in my book of the meeting with you and John Doerr. And I don't know if you remember this, but I told the story to John and he remembered it, or he kind of remembered it, but he was in the meeting and he was all scuffed up and he was falling asleep in the meeting. And afterwards he apologized. And then somebody, either you or somebody who was working with you, said, he got in a bike accident today. He flipped over his handlebars and he's on pain meds and he just got from the emergency room, but he didn't want to miss the meeting with you.
Yeah.
And I was like, wow, that is an incredible indicator of how serious of an investor John Doerr is.
There's a reason he's a legend.
Yeah.
I learned a lot from him, good and bad, but particularly a lot of good.
Yeah. What's the good? What were the good lessons that you took from John Doerr?
His dedication and commitment to his projects. Bloom just went public last week. I think he was in that project for 17 years.
17.
Before my public.
Another overnight success story.
Yeah,
17 years in the making.
Exactly. But that's John. John's amazing.
And what's the leak in his game? You sort of, there were some bad lessons there or some leak in his game? What, he's too ambitious or too big?
I think
thinking?
The way we went into green, which was all in, versus sort of getting a sense of the opportunity before we put resources and time into it, that we unfortunately missed a lot of what was going on in the Valley at the time because we were so into green. Right. I think that's John Doerr's optimism.
Right. Just going too full bore.
That's right.
You were an investor in the Tesla competitor, right? One of them?
That's right.
Yeah, that was
That's right.
So let's go through that decision. Were you involved in that one?
I was.
Yeah, so that's got to be an interesting look back, because we always look at the anti-portfolio. You guys have so many wins, so it's pretty easy for you to be intellectually honest about the losses. You invested in, what was the name of that company?
I have
Karma, Fisker.
Yeah, darn, I put it out of my brain, but thank you.
Fisker. So Fisker versus Musk.
Yes.
So you took the pitches from both, and you didn't bet on Elon Musk. Take us through the painful recollection of that.
Well, I think everybody was impressed with Elon. You can't help but be impressed. Yeah. But he didn't come from the car business. And so there was a sense that we were dealing with an arcane, complicated business, capital intensive, something we didn't fully understand.
Fascinating.
And we went with somebody coming out of the car business.
A famous person.
Fisker
was famous for making the Maseratis.
World-class designer, right? And I actually think that's a great car, frankly. I don't know if you've ever driven one. It is a great car. The Tesla's a good car.
It looks good, yeah.
It's also a very good car.
Yeah.
But the marketplace was not going to capitalize two of these companies. And Elon is a master at conveying optimism and potential to investors. And I think he was able to bridge the gap on the financing side that we couldn't get to.
Right. That was the issue, right? You had to, at that time, 2007, 2008, 2009, during the recession.
That's right.
Everything imploded.
That's right.
And he barely made it out himself. He was the skin of his teeth.
Amazing. I mean, the story of his success is very remarkable and inspiring, I think, to entrepreneurs. But they need to understand that boldness usually leads to disaster.
Right.
Right.
Which some people are betting now. Like about 20% of the people betting against, or 20% of people are betting against it being a total disaster. But he'll pull it out, I think. Let's talk about the book and why you wrote it. I'm halfway through it. And I have to say, pleasantly surprised. I thought, a list of 100 things. It's kind of like a device. I just thought, I always have this, I'm repelled by the top 10 things you need to know. But I went through it. I was like, wow, these are all check boxes that even if you've done a startup, you probably only know 60 or 70 of them. And it's a great discussion point. So explain to me how you came to the idea for Straight Talk.
Well, my co-author, John Thune Reigersman, he's very key to this because John Thune came to one of the Kleiner companies as a CFO from Goldman and Morgan Stanley. He's a Dutch guy, really, really smart guy. And when he came in, his questions were really very fresh. He put fresh eyes on what was going on in the venture business, in financings, in the startup world. And he and I would have an ongoing dialogue, even though it wasn't one of my companies. I cottoned to him because he had spent a year doing an expedition trying to climb Everest and go down 500 feet below the sea in 1 year. That was his expedition. Wow. And I just took to this guy.
Wow. Wait a second. I got to unpack this for a second.
Yes.
He wants to go 500 feet underwater.
That's right.
Which requires a submarine. You can't.
That's right.
Yeah, I don't think you can do that.
That's right.
Without a submarine. And then he wanted to go to the highest place on Earth.
That's right.
So Mariana Trench to.
That's right.
Did he actually do it?
He didn't. He did go 500 feet underwater
and survived. Incredible
yards, whatever it was. He did not get to the top of Everest.
That's a crazy journey.
Amazing.
People die every year.
I know, but this is why I was so attracted to him as a personality. So he and I would have these discussions where he would come to my office, shut the door, and I would say that the theme of these discussions, and I'm sure you have these as well, which is, how can smart people do such dumb things, right?
It happens constantly.
All the time.
We're always amazed as investors when you see the level of stupidity that can occur in the entire ecosystem.
Everywhere.
All stakeholders, not
Everywhere.
founders, team members, customers, everybody.
Investors
for
lenders,
sure. Yeah.
partners, everybody, right? And so that was the theme of about 2 years of discussions where he would close the door, come in and go, help me understand this.
Yeah.
And his fresh eyes with my experience helped us to come up with these forensics about what was really going on in the business. Understand, sometimes smart people do dumb things.
Right.
Sometimes smart people appear to do dumb things because you don't quite understand the context.
Got it.
And so when he left his job, he came to me and said, we should take those discussions from the last couple of years and make them available to everybody.
Perfect.
Anybody in this ecosystem could benefit from that.
All right, when we get back from this quick break, you have some very strong thoughts on syndicates and incubators as well.
Yes.
I want to talk about that because that's something that a lot of people listening to This Week in Startups wonder. Should I do a syndicate? Should I do an incubator? Is it worth it? When we get back on This Week in Startups with Randy Komisar of Kleiner Perkins and his new book, Straight Talk for Startups. My life is sitting down with people who want to get my money to build their dreams. And you know what I do when people email me and say, here's my great idea? I click on every link. Even if you don't put a link in, you know what I do? I go search for you, I click on your LinkedIn, I find your company name, and eventually I click through and I find your corporate website. And I look at it and I judge you by it. You know why? People judge books by their covers. That's why great covers for books will get people to sample the book, pick it up, right? And that's your website. Your website, if it's designed beautifully, will draw people into your vision. It's like a business card or maybe a beautiful suit that you're wearing or the great haircut, whatever you want to use as an analogy. People do judge books by their cover, and your website will look gorgeous if you make it with Weebly. They make it so dead simple for you to create a great looking website, but more importantly, they provide all the tools that help you turn that website into a successful business. So as I said, people judge a book by its cover, but they write the review and they buy the follow-up books and they buy books as gifts for other people if they love what's inside. Now that's with Weebly, you're gonna get that beautiful first impression, but you're gonna be able to get all the functionality. Let's say you're just an artist, you're a humble artist, and you wanna sell your stuff online. Well, with Weebly, you can build an online store that makes your products and your brand look incredible. Then you can manage inventory, right? That's a critical component. And collect payments, run promotions, and do a live chat with visitors on your site. Because those visitors wind up on your site, they're engaged. Boom, if you get that pop-up and you start chatting with them, you're gonna close sales, you're gonna find great customers. That's what Weebly does. Okay. When you're ready to grow, Weebly can also help you get discovered on search engines, very important, and to create marketing campaigns and get those return customers, which are critical. Your number one customer is your existing customer. So here is that call to action. Whether you're looking to create your side hustle or your dream job or a startup, remember, Weebly can help you get your idea out there, and visit Weebly, Weebly.com/twist for 15% off your first purchase. Again, Weebly.com/twist, you get 15% off. Weebly, more than just a beautiful website. Get to work, everybody. Make a beautiful website and then use all those tools to make a great product and service. All right, let's get back to this amazing episode. Okay, we're here with Randy Komisar from Kleiner Perkins. And his new book is out, Straight Talk for Startups. He reads it, so go to Audible and you can listen to it. Or if you want to, you can read it. Or if you do both, you can whisper sync it and then watch as the words flow by. You actually read the book yourself?
I did. But there's an interesting story. You got to hear about that.
Yes.
Because it involves you.
Oh, really?
Well, we share the same editor.
We have the same editor, yes. Alice.
And when she came to me and said, you know, it'd be nice if you read this, and the but was a bunch of caveats. You're going to sit in a dark room. You're going to reread the same lines over and over. Somebody's going to tell you to go slower and flatter, slower and flatter. But Jason loved doing it. In fact, he told us afterwards that he would do it again. And I said, well, if Jason liked it, maybe I should at least try it.
Yeah.
Right? And
Did you like it or no? Was it incredibly annoying? The first day's tough.
The first day was tough, but after you got into a rhythm, I couldn't imagine anybody else doing it. I wanted to do my book.
Right? Yeah. So I guess if people know you from podcasts or something like that, I think it's essential you do it. But then I think for authenticity, unless your voice is horrible, and my voice is not great. I mean,
No.
it's not exactly like I got hired to do radio organically. Like you have to deal with me because I decided to do it myself. But I found a trick, which is you can stop anywhere you want in a sentence. Take a breath, take a sip, and then just start again.
Yes.
Once I realized that, I was like, venture capital at its core is about, and then I just stop, have a drink, light my cigar up, then go back. Focusing on your winners and doubling and tripling down. You just literally can stop. And you don't realize you can do that.
I wish you'd give me that hint before. I didn't quite figure that out completely. But
my favorite part is, if you get one word wrong, they stop you.
I know.
Or if it's a tense and you're like, well, that makes no difference. Like the venture capitalist or the venture capitalist, it has the same meaning. They're like, yeah, but you have to say exactly what's in the book because of whisper sync.
Yeah. Oh, is that
That's
why?
the reason.
Is that
because they take each word and match it to the sound. So that when you listen, if you have Audible and you have a Kindle, when you're on your iPad or whatever, you can hit play, hear your voice, and watch each word highlight, which increases retention, I believe, because I've been trying to figure out how people learn new skills and been researching it. And if you're an auditory learner or a visual learner or a reader, you get all of those at once because you're hearing it and seeing it. And you're thinking it and reading it. Anyway.
I didn't know that because it's interesting because I kept saying that they correct my word and I go, I wrote the book, it doesn't really matter.
Yeah.
And they go, no, you have to go back and reread it.
Exactly as it is. Okay, when we went to break, you have some strong feelings about incubators and if they're worth it. You say in the book, hey, it's worth it to meet investors, but not to find product market fit. And you kind of, I wouldn't say you diss them, but you contextualize them as like good for a certain group of people. Who are incubators? And let's just say it's one of the top incubators, like Y Combinator, Launch Incubator, whatever it is you consider the top. Who is it right for and why?
Well, first of all, I think Silicon Valley, the Bay Area, is one big incubator, right? Most of the world isn't blessed with this ecosystem and this community.
Yeah.
And so incubators outside of a place like Silicon Valley make a lot of sense, right? If you're in Warsaw, there's not a strong entrepreneurial community that you can rely on. You need a safe haven, right? You need four walls confining you.
You're not going to run into people on the street.
Not going to run into people on the street.
Yeah.
Here, if you're an incubator, you actually have the liability of maybe not running into people on the street, right? Because you're so self-contained.
Right.
So there is a trade-off there. But I do believe that if you're looking for a great network and you're looking for the validation in that network so that people will take you seriously, I think incubators can do that for you. I also think incubators can explain to you how to communicate your ideas well in a compelling way. And that is key. That's a key entrepreneurial skill set. It's not a nice to have. So
it's critical that you know how to present your idea.
Absolutely.
Because why? Is it a tell if you can't, or is it that you're going to be doing it all the time to hire people and sell?
In this business,
so
we are always selling our ideas all of the time. And if we're not capable of doing that, we've got to associate with somebody who can.
And so who's it not for? What would you say is the incubators are not for? Or if there is a downside, what is the downside?
I think if you have a strong network already, then they can actually be isolating versus expansive, right? And I also think that if you have a strong base for you building your own business and attracting your own employees and investors beforehand, then you're not going to get much value from it.
If you already have the network, if it's your Mark Pink is doing Zynga, everybody knows who you are already. You don't really need any extra love. You tell a story about a Y Combinator company, whether it's true or not, but a rumored story that they changed their pitch the week before and then closed funding the day of their demo. Explain that story and why it's relevant.
Well, because if you take a look at a Y Combinator company presentation, they always have the hockey stick charts.
Yes.
With nothing on the axis, right? Nothing, no metrics.
Nothing suspicious there.
nothing. And the interesting thing about this company, the story, again, whether it's true or not, I don't know. The story is that a company in its last week of its 13 weeks with Y Combinator changes its business completely, doesn't change its slide deck, presents and gets money. And using the exact same hockey sticks, new business. And I think that's an indication of the obfuscation that communication can actually provide. They make my job harder, frankly. Because everything coming out of there looks about the same, the good and the bad. Right?
They're basically trained people to do the total addressable market is trillions.
That's right.
The competition is nothing.
That's right.
And here's our first 12 weeks. It's basically like if you put Uber and Bird and Facebook together and then poured gasoline on
That's
it.
right.
That's what we are.
But even better than that, even better than the growth curves, right? They'll show you Uber's growth curve and Twitter's growth curve, and then they'll show you their first 2 days of their growth curve that are actually surpassed.
For sure. My favorite is when you look at it and then you're like, how much of this was paid?
Yeah.
And can you show me the actual data and give me your Google Analytics or whatever? They're like, yeah, that's all paid. I'm like, oh, so you spent 100 on Facebook ads week 1, 200 week 2. I do this at roulette. Yes, you double the bet each week. It looks pretty cool. So you talk a little bit about creating business plans, and one of them being aspirational and the other one being execution. Explain that, because that one I thought was pretty interesting. A lot of people say business plans don't matter for startups, but you seem to think making a plan is a good thing. Explain why it's a good thing.
Well, let me take it one step back to Getting a Plan B, which was a book that I wrote in the mid-2000s that fundamentally has been interpreted as saying business plans don't matter. And in that book, we take a look at the business plans of successful companies and demonstrate how narrow their connection is to the actual success or failure of the business ultimately.
No correlation.
Virtually none. Right? Virtually none. And I always say that if you create a business plan before you have a product, before you have a customer, before you have $1 of revenue, and it turns out to be right, you are lucky, not smart. And the reason is you don't have enough information to be smart, right? And I don't invest in luck. All right. I mean, I hope to get lucky.
Sure.
But I can't invest in luck. I can't assume that a house of money.
Not quantifiable.
A house of money can't fall on somebody's head every day. Right. So that book often gets interpreted as saying, well, if you don't believe there's a correlation,
then why do them?
And a lot of investors, a lot of entrepreneurs come into my office and they don't have a business plan. And I say, well, you're the guy who says we don't have to have business plans.
Right.
And I'll say, wait a minute, stop.
Yeah.
I need to see a business plan because I need to see how you think.
Right.
That's the lingua franca of the business. I need to see your assumptions, your sensitivities. I'm not going to base my investment on your business plan, but your business plan is going to tell me whether I can base my investment on you.
Right. So your ability to strategize and understand what you're trying to do is what the business plan is for. It's not exactly a map because you're going to the new world. You don't even know it's there.
Exactly.
You can't make a map till you visited it or had a flyover. Right.
So that gets to two business plans. Yeah. So a lot of times when I'm sitting down with entrepreneurs, they are perplexed, right? They're coming up with this business plan for the future. It's based upon a bunch of assumptions, and they're trying to come up with one set of numbers that they're going to argue defines their future to some investor or some partner or some employee, key employee.
Right.
I'm saying, why one? We really need is two. We need a base set of plans that show how your costs are going to increase over time as you take out risk and prove out your business. That you should have your arms around. You should be able to give me a very clear cost model for how your business is going to expand over time.
Yeah.
But on the other side of the coin, I don't want your aspirations to be limited by your costs. I don't want them to be conservative. I want you to be thinking out of the box in terms of what the opportunity is here, and to be able to express that potential to investors, to partners, to key employees, so that they see the vision here.
When people put those crazy aspirational plans out there and they're not, is there a risk of seeming like you're not connected to reality? Because the growth of Airbnb or Uber or some of these businesses have been so violent and, sort of unnatural, I guess is probably the best word. They're so unnatural that to actually save them before they happen, you seem kind of crazy.
Yeah. I think they seem crazier if it's your only plan. If you come in with two plans showing me I'm well-grounded in how to actually manage your money, to test my assumptions and remove risk. But on the other hand, let's talk about what might happen here. Let's dream the dream together with the aspirational plan.
Got it. So, hey, here's my unit economics for Uber or Airbnb. Here's how it works in San Francisco. But aspirational could be, and here's what happens if we have 1,000 cities and we have 5 product lines.
And list what those things are. Here's the 5 things. Here's where lightning can strike me. Right?
Yeah. Because that really is what it's about, isn't it? Like you have some idea there's a business over here and you're triangulating on it, but there's always these things that you didn't anticipate that send the business to a bigger place.
Well, and in the book, and after you finish the last half, we can talk further.
Yeah.
But in the book, a lot of the underpinning of this book is about luck.
Yeah.
It's about the idea that things that make you successful are generally unpredictable and out of your control. And that luck is a skill to be mastered, meaning to be able to identify luck, your lucky break when it happens, and to seize the moment, and to have the excellence to be able to execute against that. That's a business skill.
Right.
I believe luck is a business skill. And I believe you need to be a generator of success, you got to be a lightning rod for luck.
So putting yourself in the position to be lucky.
Exactly right.
Yeah, as I tell people, I got lucky 7 times.
Yeah, right. Exactly. Exactly.
Or maybe 8 now.
Yeah.
Who knows? All right, when we get back from this quick break, I want to talk to you about how the market has changed vis-a-vis venture capitalists are now having much larger funds. And we have this Masayoshi-san fund, we have Sequoia's growth fund, you have these huge growth funds, and venture funds seem to have become $2 billion for venture funds. How does that affect how entrepreneurs go to market when we get back on This Week in Startups? You know, I'm constantly counseling my startups about finding their dream customers and marketing to those dream customers. And typically, all you know about your customers is their geography, maybe, perhaps their business title, what they do for a living. Oh, you want to reach a VP of engineering? Great. Whoa, the other startup may want to reach the head of HR. And they have to have human resources or human capital in their title, right? How do you reach these people? How do you actually find them? Well, right about now, you're probably thinking LinkedIn. That's how you find them if you're searching for people for jobs. But what if those people are your customers? Forget about hiring people for a second, which LinkedIn's that awesome at. I want to talk to you about LinkedIn marketing. LinkedIn is the world's largest professional network. You know that. I don't have to tell you that because you're on it. And every day, 500 million professionals engage with the content on LinkedIn. And your future customers are among them. And LinkedIn has marketing tools to help you target your customers with exact precision. That means down to the job title and the company name and the industry. So let's say you were selling sales software, or let's say you were selling meditation software or HR software, or you're selling this podcast. Who do you want to listen to it? Well, I want venture capitalists maybe to come to the Launch Angel Summit. Well, we marketed to venture capitalists and investors and banks to come to the Launch Angel Summit this past summer, and it worked. We sold actual tickets through the use of LinkedIn because they can get you the job title and the industry, and this will get you higher quality leads. In fact, 4 out of 5 customers on LinkedIn are decision makers for their company. You know this because you're on LinkedIn, and you know this because you're a decision maker. You're building relationships that really matter when you're on LinkedIn, and using LinkedIn marketing tools are going to help you scale your growth. So here's what I want you to do. I'm going to give you $100. What? $100 LinkedIn ad credit. That's $100 for you. And here's how you get it. You go to linkedin.com/thisweekinstartups. linkedin.com/thisweekinstartups. Now, I know that's a lot to type in, but for each of those characters, you're going to get like $10. It's $100 just waiting for you to go try their ad network. That means you can get more customers. And why would they give you the $100? They're super confident that you're going to use that 100, it's going to work for you, and you're going to be emboldened to spend more on their network. They know it will work, so LinkedIn's going to give you that $100 right now. LinkedIn.com/thisweekinstartups to get it. And understand that as an angel investor or my downstream venture capital friends, they are going to judge you by your ability to spend money to build your business. It's not enough to grow organically. You have to have hypergrowth. You have to have blitzkrieg, blitzscale growth, as Reid Hoffman, the founder of LinkedIn, would say. You need to have hypergrowth, unrealistic, inhuman growth. How are you going to do it? You're going to find those great customers on LinkedIn by going to linkedin.com/thisweekinstartups and getting your $100. All right. I could talk about LinkedIn all day because I love it and I use it all the time. You're seeing me post my clips from this very show on LinkedIn. I'm on there every day, multiple times a day, so you can advertise to me as well. All right. Great job, LinkedIn. Let's get back to this amazing program. Hey, everybody. I'm here with Randy Komisar. He is the author of Straight Talk for Startups, which people are raving about, and I can tell you I'm halfway through it. I've been listening to it. It is fantastic. It's one of these things where I think you can jump around in the book too, which is nice. You don't have to read it sequentially.
By design.
Yeah. So if you're, by design.
By design.
Yeah.
1 to 3 page chapters so that people can just focus on the thing they need to know, not worry about having to get through a dozen pages to get to the point.
Yeah. It seems like you were very much in get to the point mode. Did you overwrite some of the chapters and then just cut a lot to try to make them shorter and more concise?
Well, this is one of those books that came together in a week after a year and a half of getting it wrong. Right?
Got it.
Right? John Toon, my co-author, was spending a lot of time trying to bring all these ideas under one umbrella, and you can imagine how hard that was to read.
Yeah.
Right?
Of course.
And then John Toon came back to me and said, what if we just break it up into minimalist ideas, and then you can write it this way?
Yeah, in chunks.
And frankly, it really worked for me.
Yeah, no, it's much better. I mean, if you can chunk it the way you have into, mastering the fundamentals when you're starting, then you get into selecting the right investors, what is the ideal fundraise, and then building, managing effective boards, which is a skill in of itself, which most founders don't even get into until year 4 or 5, I guess, and achieving liquidity. Let's talk a little bit about how venture capital has changed. 10 years ago, there weren't that many companies. There weren't that many angel investors, but things seem to have radically changed, and I think we could both argue we're seeing a peak that we've never seen before. You worried about the market correcting, crashing? You think this is all sustainable?
It does not seem to be. What's going on from a strictly economic perspective doesn't seem rational, right? It seems like that risk is not being fully taken into account in the pricing and the capital moving into these markets.
Got it.
And if you take a look at the way that venture capital funds now work, 20 years ago, a fund, at the base level of a fund, a portfolio, could return 1 to 2x, and then you'd have some huge hits off of that that could move that fund to 3 to 6 to 10x returns, right? If you're
cash
lucky.
on cash.
Cash on cash.
Right.
But today, the portfolio itself is generally going to be negative. You're going to lose money on the portfolio. You're going to make your money only on your black swans.
Right.
And that's because you are paying such large sums of money to participate in the failed businesses that you can only sustain those with these extraordinary outcomes that we see around the valley.
Okay. So is that a function of investors being greedy and wanting to build bigger funds? Is it people staying private longer so they can put together, or they can put private money to use longer? How did we get here, do you think? Because I remember when I was coming up, $3 million was an A round for a 30-year company. You felt pretty happy about that, or a quarter, 25% of your company. Now $3 million is a seed round for 20% of your company, and then a Series A is $10 million for 20%.
Yeah.
$50 million posts.
Yeah. Crazy.
It seems weird.
Crazy. I think there's a whole bunch of factors that led to this.
Yeah.
First of all, I think there's just a lot of capital on the sidelines. And the amount, this capital, because of low interest rates since 2008, have been looking to juice their returns.
Got it.
And they have been willing to ignore risk to get into these very, very high profile opportunities in order to try to juice the returns across their portfolio.
Got it.
I think raising interest rates as inflation starts to set in, that's going to dampen this a bit because capital is going to have other places to go.
Right.
So that's one issue.
Yeah.
I think another issue is we have seen a lot of very, very talented angel investors come into the marketplace, and they don't need to have the trappings of a venture capital firm in order to do their work. When I was working as an entrepreneur with venture capital in the 80s and 90s, in those days, Sequoia and Kleiner probably saw 90% of all the deals.
It was the first two stops.
Absolutely.
For me, it was, the first two stops.
So you didn't have to be brilliant to make a lot of money. You just had to be a little better than average because you had great deal flow.
You had to show up.
Absolutely.
Yeah.
What's happened since is, each of those companies, us, Sequoia, all of them are just seeing a smaller and smaller percentage because there's so many places for them to go, which means we have to be actually a lot smarter to do our business well.
You got to work harder.
Much harder. We have to be hard. We have to work harder to get the deals. We have to work harder to win the deals. We got to work harder to support the deals.
So that's good, isn't it? Isn't that good for the ecosystem that venture capitalists have more competition?
I do. I think that's good for the ecosystem. It may not be good for venture capitalists.
Let's explain why that is. I have some guesses here, but the venture capitalists seem to be going downstream and doing only Series B. Is the issue, I'm just guessing here, that by that time they may have much more competition to do that Series B, and they don't have a good relationship with the founder because it's year 4 or 5 and they haven't been there since the beginning?
I think what it means is, as you see these larger and larger funds being raised by venture capitalists, that means that fundamentally they've got to write bigger checks. They've got to go in later into the process, and they're not going to have the opportunities for those 20x, 50x, sometimes 100x returns.
Yeah.
They're just not there. So you're going to see these funds that were at the top decile, probably 5x funds, move to 2.5 or 3x funds. Right? And I think what you will see is syndicates of angels and smaller venture capitalists actually start to produce really great multiples on smaller numbers.
Yeah. I mean, that's definitely sort of where we live, is higher multiple, smaller dollar amounts.
Yep.
Is the management fees that venture capitalists what perverted all this? And maybe some old school VCs just been like, you know what, I'm getting 30 and 2 or 30% carry and 2%, management fee. If I raise a $500 million fund, I'm getting $10 million a year. But if I raise $1 billion, I'm getting $20 million a year.
I don't think they were the motivation, but I think they have made the transition easier, right? Because if you're not relying on your carry to produce extraordinary returns, which, by the way, your limiteds want because they participate in that, if that's not what you're doing, because your fees are so high that it's really not critical any longer that you get a $10 million, $20 million hit off of your carry. That dampens the enthusiasm and changes the incentives. I don't believe it was the motivation. I do think it was context.
Right. Yeah, it's just a contributing factor,
That's
but
right.
not the factor.
That's right.
The factor is you have these LPs who are not getting any return anywhere else, so they double down on venture capital.
That's right.
The venture capitalists have a hard time not taking the money, so they do bigger funds. Then they demand that founders take more money, or founders want to naturally take more money, and either that founder puts it to work or it blows up.
That's right. And I think what you'll see is, like with any growth investor, because they're investing further down the stream, they're going to have fewer failures, but they're going to have also fewer black swans.
Right.
Right?
Defined as like a 50x or something.
Exactly.
Something that can return the portfolio.
Something really change the landscape.
People thought you guys were crazy when you made that late, I think it was $100 million into Twitter.
No.
What was the valuation when you guys did that? $4 billion or something?
It was something like maybe three and change. Yeah.
And everybody's like, oh, Kleiner's late to the party. They're catching up. But that wound up being 10x, 20x, no, 10 to 15x, depending on when you liquidated. That would wind up being at least 4x, probably more like 10x, depending on when you liquidated, on $100 million.
Yeah, right.
That's a big number to 10x.
Yeah.
That returned the fund, that one investment?
Well, that came out of our growth fund. It was certainly a huge contributor to it.
Yeah.
But at that time, and Mary Meeker had just come on board to come up with a strategy for how to invest bigger checks.
Got it. And what was the strategy she came up with?
Well, the strategy, I think, came from her work at Morgan Stanley before, where she really saw these straddles, where she saw these companies that were getting to scale and moving towards liquidity, and the opportunity to invest in those straddles and still make really good 2 to 5x returns.
Yeah, on a big number of cash, which is kind of what Yuri Milner did, right? That was kind of his playbook.
Exactly.
I'll overpay for Facebook, but I'm going to look really smart.
When you have oligarch money, you can do anything you want.
It worked out pretty good, I think. I don't think he could go back to Russia, though. No. He's not I don't think they'll let him back in the country, nor would he want to. So what does all of this seed investing mean for entrepreneurs when they go to market? Because it used to be that you qualified a venture firm, and then you kind of built your short list. I had my short list. I was consumer internet. So it was like, well, Kleiner and Sequoia both did Google and YouTube and all these other great companies. It has to be one of those two. Right? It was in my mind, I have to get one of those two or else it's not a good idea. But now if venture capitalists are going downstream, is there a difference between picking a great venture capitalist, which you kind of make these personas in the book, which I thought was pretty smart, the quant, the domain expert, the people person. You had these different sort of archetypes. Let's go through those archetypes and then talk about picking a seed fund or an angel or a syndicate versus a venture fund. Take those two questions either way you want.
Well, let's start with, I think, the confusion that the nomenclature gives us right now. As you point out, seed really looks like the old A, right? The old Series A investment. And I think we should get rid of this nomenclature. What we should be talking about is companies that are pre-product, that are pre-revenue, that are pre-inflection scaling, that are pre-profitable.
Right.
And rather than these silly Series A, B, C stuff, because what we've simply done is we've created this seed round that is the Series A.
It is a Series A.
That's what we've done.
Yeah.
Because everything else looks like the Series A, except that we had to wedge it in to this nomenclature because the venture capitalists still want to keep the Series A in their ballpark. And why? Because they want the LPs to still think of them as venture investors.
Not growth ones.
How else are you going to get those fees and carries?
Got it. So if you're going to get fees and carry on that level, you have to look like you're finding these deals.
Exactly.
If you're just doing what Mary Meeker did at Morgan Stanley and just finding them when they break out, that's not as hard a skill.
It's a different skill.
It's a different skill.
I can't do what Mary does. And she's much better than I could ever be.
Yeah. You got to convince people to take the money in that case, right?
Well, more importantly, Mary has this wonderful ability, which I don't have, which is she can look at an early success and envision ultimate success. I look at an early success and I think of all the reasons it's going to fail.
Right. Because you've seen it up close.
I'm a venture capitalist, right?
What do you think the top reasons are today things fail? When you look at today's market, why are founders failing? When you see somebody fail, what are the top reasons startups fail?
First of all, the innovation world requires a lot of failure. Innovation and experimentation relies on failure. If you expect a low level of failure, you're not innovating. Right. So as an ecosystem, we should expect a lot of failure. The question is, how much are we willing to spend on failure? And when I look at what's going on in the failed experiment side of things, the problem is that we're putting too much money behind unproven ideas without a methodical way of de-risking them. And so we are wasting more money on the failures than we should. It's not that there are more failures than there should be. There should be every one of those failures and more.
But they're overfunded failures. They leave a bigger crater.
They're taking too long to fail, meaning we're wasting talent, and they're costing too much to fail. We're wasting money.
Right. So burning through $100K or $250K in seed funding or funding from a syndicate or funding from an incubator, no big deal.
That's right.
But raising $3 million and taking 3 years to prove nothing is the sin.
Well, and in fact, in the book, one of the chapters is that most entrepreneurs fail from indigestion, not from malnourishment. Malnourishment, exactly.
Right.
And
expand on that. What does that mean? They take on too much, or
what happens is when you've got too much capital, you're insulated from market information. What you want to do as an early stage company is you want to test your assumptions as quickly as possible and gather data to decide which of your assumptions are right, which ones need refinement, and where, if any, there's a pivot direction for you on the false assumptions. Right? That's what you want. And
lean startup style. You run a test for as cheap as possible.
Quickly discover your business. Quickly discover your business. It was what getting to Plan B was all about, the dashboarding process.
And people make this mistake when they raise a bunch of money to spend a year building something without ever talking to customers. They
Crazy.
Taj Mahal syndrome. Yeah.
Well, even worse. If I give you too much money and you go talk to customers and they tell you no, you think, you know what, they don't get it yet. I'll just keep spending money because I'm right, they're wrong.
Yeah, the customer's wrong.
If I give you too little money, guess what? You're going to be very responsive because you need that customer.
Yeah. You're going to be really tuned into how do I make a business out of this quicker?
That's right.
You'll get to ground truth quicker too.
That's why indigestion is a big destroyer of great ideas.
Which means focus and being lean leads to success quicker. I think we can say that pretty easily.
Let's put it this way. It's going to lead to success or failure quicker. Either way, it's going to be a more efficient way of innovation.
Right. You're going to get to ultimate success quicker because if you find out, and you mentioned this in the book, a failed experiment is not a failure. It's a confirmation that you shouldn't do that.
That's right.
It's like a really good way to look at it.
That's right.
You've eliminated a possible thing to focus on. Go through the different VCs and how you look at them. Because when you came into VC, you were one of the rare operator VCs. It used to be all Harvard MBA, Stanford MBA. You're a Stanford MBA?
No.
Harvard MBA?
No.
No MBA?
No.
Zero MBA?
Zero.
Did you go to undergrad? You did, okay.
Yeah.
But when you came into venture, not having an MBA, not having gone to Stanford or Harvard was kind of weird, yes?
Well, so...
Or not common.
The thing to think about is when Tom Perkins and Eugene Kleiner started Kleiner Perkins, they were operators. And all of the venture cowboys in that era...
Yeah, the 70s.
They were operators. They weren't MBAs. They weren't financial architects. They weren't people who would be happy in hedge funds on Wall Street, except that there was more money moving around in the Bay Area than Wall Street, so they came west.
Right.
These are people who were entrepreneurs investing in entrepreneurs. That's what I am.
Right.
I'm an entrepreneur investing in entrepreneurs. I don't think like an investor. I certainly don't think like a banker.
Yeah.
And when I gravitated towards venture capital, frankly, I had a lot to learn about investing other people's money. I'd always invested my money. I'd invested my time. Investing other people's money is different.
How?
Well, in the sense that when other people give me money in order to make money, when I invest, making money is not my primary goal. Now, I do not want you to take from that I don't care about my investments making money. It's just that I see making money as the first derivative of backing a great entrepreneur, of solving a big problem, of creating a great product, right? It's the first derivative.
Right.
But if you're investing other people's money, that becomes a more complicated puzzle to solve.
Do you find you're more focused and less loosey-goosey as a way to describe it? Would that be accurate?
I would say that was part of my my maturation. But then I came back to where I started, which was the only thing I understood was talent.
Right.
I'm not a thematic investor. One of the investors I talk about in the book, somebody who has a thesis for how the world is going to operate and then invest in that thesis.
So VR is going to be huge.
Exactly. Let's just do VR.
All VR.
Cryptocurrency, let's just do cryptocurrency, right? There are people with that, and if they're in the right place at the right time, they can make a lot of money.
Right.
Chances are that they can do that once, right?
Yeah.
Right?
You would have to time it perfectly, and it would have to actually happen.
Exactly. And then they have to be smart to figure out the next one. God bless them, right?
Yeah.
Then there's also the domain expert investors, the guys who come from a particular market and see a hole. They see a problem in there that only somebody inside the market can see, and they're going to solve that.
So there were some people who did just networking.
Exactly.
Like actually Vinod Khosla, I think, was like very much into the networking software in the early days.
Very much so.
Right.
Very much. And he was brilliant at it.
Right.
Brilliant at it, right?
Right.
Because he saw it from a domain standpoint.
Yeah.
Right?
I like the analogy you used in the book. You said it's like the people who look for the keys under the lamppost, like under the light. It's like
exactly.
They know that there's light here.
Exactly.
They have perfect visibility on the security space was the analogy you used. And so it's very easy for them to know there's a market for it. But what they wouldn't be able to see is stuff that's outside of the market that would be black swan territory.
Which to me is always the interesting place to be.
It's kind of the magic, right? In terms of binary returns.
That's why I love being here, right?
Yeah.
I mean, otherwise it's not interesting to me. Now, we also talk about quants. The new quant investors, these young MBAs that have come in that have no instincts, no operating skills, but they look for inflection points in the data. And because there's so much data out there today, you can do that in a way that could never be done even 10 years ago. Right?
That was kind of like social capital's idea, was they were going to just quantify everything then capital as a service.
That's right.
What do you think of that idea, capital as a service? They pull in all the data, they spit back out a check.
You have
You're
to look
smirking.
at the results.
Yeah.
Look at the results.
Well, Slack was a big result, but
great, and we have Mamoon now. So
you have Mamoon. Yeah. So bringing up a sensitive topic, there was rumors that Chamath was being recruited to come to Kleiner or merge Social Capital. That didn't happen, but Mamoon came and is running the early startup business.
Yes. Well, he's not running it, but he's a principal.
He's a principal. So he's like one of the main guys.
That's right.
Main team members there. So, yeah. Is that true? You guys tried to recruit Chamath, I guess? Or there were discussions?
I think language is important here.
Sure.
We had conversations as we were looking for how to refresh and renew our... Look, we were all getting older at Kleiner, right?
Yeah.
We had all sort of come through this green investing streak that we needed to dig out from, right? By the way, I think going into green investing, sustainable investing is exactly what venture capitalists should do.
Right.
But they should do it in a measured way.
Right.
When we didn't. right? We didn't. So we had to dig out from that. And when Ted Schlein came to a group of us in just after 2010 and said, let's rebuild this company, this firm, and let's go back and start to get involved in all of the other spaces that we've ignored over the last 4 or 5 years. 4 or 5 of us signed up to do it. Seidenberg, May, John, Mike Abbott, John Doerr, and Ted Schlein. That was it. That was the group.
Right.
And we went out and said, okay, let's get this place back together again and focused. Yeah. And the returns you're seeing now, I think we did more IPOs last week than we'd done in any month in the last 10 or 15 years. That's the result of investing starting.
You guys got back to your knitting.
Exactly.
Right. Which was Series A, Series Bs of high-tech companies.
So as we came out of that, feeling like we're feeling pretty good about where we are again, but realizing we now need new talent to follow this talent that's getting a little, older.
Yeah.
We started looking around. And Chamath and his team were definitely one of the candidates that we looked at. We said, do we hire everybody? Do we bring in a group? So we looked at a variety of things.
He had some good ideas, right? I mean, he's a pretty smart cat. He figured out a lot of things that were wrong in venture capital and kind of pushed the envelope.
He's clearly very, very bright. It just was not a great fit for what we wanted to accomplish. And Mamoon, I think, is a much better cultural fit for Kleiner Perkins.
And he's the guy who found Slack, is that right?
That's right.
So, I mean, he's basically the guy who is responsible for the big hit over at Social Capital anyway. So now you got him on your team. Let's talk about that sort of, when should venture capitalists retire and get out? I think Benchmark has their own view, like whatever age it is. They have an age cap, like Logan's Run or something. You're 55, 60. What's the best way to do succession planning at a venture firm? Because you guys are learning that, I think, in real time.
Yeah, I mean, I don't think there's a retirement age. I mean, look, John Doerr should never retire, right? He may want to play a different role. Maybe he should play a different role, but his enthusiasm and his experience and his network are so valuable. Why would you ever put it on the sideline? Right.
Makes no sense.
It makes no sense. I do think, though, that you always need fresh eyes.
Right.
I mean, I'm a boiled frog, right? I mean, it was funny in writing this book. It was Jantoon's fresh eyes that that focused me on the things that people needed to know. Because I knew all of that. I could write, literally could write all of that in a week, which is how it got written.
Yeah.
After a year and a half of Jantoon breaking his pick. Right. That being said, it could only happen with Jantoon because I know all that, but I don't know what you need to know because I've been doing this a long time.
Right.
And I actually feel like for somebody like me, the opportunity now is to work with talent. Investing other people's money is just not as attractive as it was when I came to Kleiner Perkins because I saw it as a scarce resource. To be able to assemble all the money, to be able to support a team out of the blocks without having to go and beg it from others.
Right.
Just not the case anymore. The money is everywhere.
Right.
Talent and the development of talent, that to me is the scarce resource in the entrepreneurial community.
Yeah. And you have to compete for it more because people who used to be the number 2, 3, or 4 person at a Google or a YouTube, they now have their own idea for a business and they're running it. So you have this talent diffusion or dilution, I guess would be a better. Maybe both words work, but it's a little bit of talent dilution, don't you feel?
I think there is. I think the real issue is not the raw talent, but what we do in this book, which is how do you give raw talent the benefit of experience to accelerate their success and to avoid the pitfalls? I mean, that's what that book was written for.
Yeah.
The book was basically, what can we do to help entrepreneurs from crashing cars while they're learning to drive?
You say in the book, which I thought was a kind of interesting one, when it comes to getting a call from associate, it can feel really special. But in fact, that associate is probably calling every single person in your vertical. So if you're a health company making subscription apps, they're probably calling every single subscription app company that has existed or failed or whatever. And that you really want to move to the decision maker. How do you do that deftly without insulting the associate who can have influence, but might not be the person who actually pulls the trigger? How do you manage that as a founder when the associate calls?
I think you have to make them your ally. I think without offending them, you need to let them understand that you quickly need to get a sense of the support he's going to get or she's going to get in her organization. And you need to turn this into, how am I going to help you, associate, get the support for this project? I like you. You understand my business. We have a good rapport, but I quickly need to get this risen to a level where I understand the commitment of your organization, and I'm going to do you the favor. I'm going to go in and sell your support of my idea. Let's figure out how to do that.
Got it. When should a founder sell a company?
Well,
because you must have them come to you and ask, like, should I sell or not? See, and they want to give you a yes or no.
And I hate to spoil the ending for you.
Yes.
Because there's a lot about this in the end of the book.
I know. That's why I'm bringing it up.
So I think first of all, the idea that there's a machismo heroic story about holding out against all odds and not selling to Yahoo for $1 billion and suddenly being worth $400 billion at Facebook.
Yeah.
Those are the hero stories.
Yeah.
We need to understand how freaking rare those are.
Yeah.
Right? And we need to understand that for every one of those, there's a whole bunch of companies that didn't take the offer and disappeared.
It went to zero.
Zero.
Yeah. I mean,
Zero.
I was bringing this up with somebody. I was like, I think actually one of your investors, One Kings Lane and Fab.com,
Yeah.
These went to not Girl Boss, Nasty Gal. These were all in the same kind of fast fashion, e-commerce, direct-to-consumer. They all ran up to billions.
They were shooting stars.
They were shooting stars and they collapsed. Why did why did that whole category get wiped out? What did you learn from that?
That's a good question. I think the brand business versus the product business is just a really difficult business. It's about timing. It's about, you probably understand better than I do because it's about media more than it's about content.
Yeah.
Right, and it's difficult. It's a very difficult market to reconnoiter. I certainly don't have an instinct for it.
Yeah, and I don't think that it just may not be a venture business, right? There might be a better private equity, slow and steady, build it over 20 years business. You put artificial growth behind those businesses. Or,
I love you saying that
growth.
because I effing love that company is about just this.
Yeah.
I wrote it with a fellow by the name of Bayard Winthrop. You may know him. He runs something called American Giant. Right. American Giant is a made in America brand right here in San Francisco.
Hoodies.
They make the best hoodie in America, right? It says proclaimed by a number of critics.
Yeah.
But they also make a lot of other great products. And my advice to him in building this business was to expand it not to meet the needs of capital, who wants them to be big, but to meet the needs of customers, to focus on quality and to be pulled to scale by customer demand, rather than using capital to generate non-economic demand.
Non-economic demand?
Meaning demand.
Fake demand.
Demand where the customer is never going to pay for their acquisition costs.
Right.
Right?
Oh, yeah, that would
Vanity
be bad.
numbers. Vanity numbers.
Let's jump into that. It seems like a lot of venture capitalists were rewarding the vanity numbers with huge rounds and valuations. So you're sitting here as a venture capitalist lamenting these vanity numbers and growth, but aren't you and your brethren responsible in some way for this? Yes.
I mean, the game, we played our part in the game.
Right.
And this has to do with the quant investor. Remember, I talk about the rise of the quant investors.
Yeah.
Well, they went out and started to get a whole bunch of data. And they were dealing with, it's kind of like genetics and epigenetics, right? We have all the genetic data, but we really can't tell you whether you're going to get the disease or not.
Right.
We need the epigenetic data.
Right.
And we weren't getting that. And I think now, if you take a look, most investors are much better at understanding, like you are. I mean, are those gross numbers real numbers? Are they return numbers? Are they paying for the CAC? What are those numbers?
Right? Yeah, because you can manipulate one or two numbers. Yeah. But when you start looking at 5 or 6, the truth is going to come out. Yeah. And so founders shouldn't play that game. They should play the long game, the unit economic game.
Well, yeah, I am loath to tell founders who are able to raise money at a huge valuation from a blue chip venture capitalist and then turn that into an early sale of a company or product that still isn't profitable, that it was a bad idea to do it. But it's not my idea of how to build a business.
So refreshing.
Right?
Yeah, no, I mean, Randy, it's very refreshing in terms of candidness because there is an upside. If you're a founder and a great firm gives you some money to extend this delusion, and you don't take it, well, when the market crashes, you feel pretty stupid.
Absolutely.
And I guess you have to, I'm thinking it through here, you would just have to understand the delusion and have enough runway to change gears? Would that be the intelligent gamesmanship?
And I love the term delusion because I use it as well. I look for entrepreneurs who are super optimistic, but not delusional, meaning that they know where they have exaggerated their numbers or opportunities. I talk about lying. Lying crosses a different line.
Yes.
But they know where they have pushed these things. And they know that if I write them a check, they're not going there.
Right.
They're going to be much more methodical in doing it. If I were an entrepreneur and a blue chip venture capitalist offered me a big check with little dilution, I would take it, put it in a bank, and I would use it in a responsible way.
Yes.
Right?
So even if the capital was given to you in a greedy, opportunistic way by the venture capitalist firm who's trying to just, run out their $1 billion fund, you should take it and deploy it intelligently. You can raise it delusionally and deploy it intelligently.
You can, if you've got enough self-discipline, then you don't need the discipline of the marketplace to get you there. But most entrepreneurs don't have it.
How do you mentor undisciplined founders? Because in the position we're in as investors, we don't get to run the companies, but you and I were both former operators and we're thinkers and talkers as well. How do you steer an entrepreneur towards what's virtuous and away from that which is not?
Well, it does start with an understanding of why. In the book, the epilogue is about our cardinal rule, which is always ask why. Why this? Why you? Why now?
Right.
And understanding that sets your compass in the right direction.
Why this? Why you? And why now?
Exactly.
The why now everybody knows because that's been talked about ad nauseum, which is there some new technology that's
some
emerged, like
opportunity,
GPS,
some special
or VR?
opportunity, right?
Something's changed in the landscape.
Right.
But what about the other two? You and this?
Why this project? Why is this project important? Why is it important enough, frankly, given the statistics in our business? Why is it important enough to fail? Because it's more likely than not, you will fail.
That's an interesting way of looking at it. If the majority case is failure, why is this a worthy failure, worthy of burning 2 or 3 years of your entrepreneur's life and $10 million of your capital?
And how will you feel you have advanced your life and your career at the end of it, even if this folds?
Right.
Right?
Yeah.
So that's why this. And why you is, what do you bring that's special to this?
Yeah.
What insight, what character, what grit or tenacity do you bring to this opportunity that nobody else brings? Because if you're not special and this opportunity isn't special and the timing isn't right, find something else.
Resiliency or domain expertise, which would you take in an investment?
Resiliency.
Resiliency, hands down.
Hands down.
Resiliency versus product execution, which do you take?
I like product execution a lot, but ultimately you'll probably be wrong, so I need resiliency again.
Right. It is. I asked the question that way to make you think about it for a second, because it does seem the people who win are not always the people with the domain expertise or even who make the prettiest product. They're the ones who just don't give up or figure out a way to not fail.
That's right. That's right. That's right. I mean, in one of the hardest thing is for me to get into hospice mode, right? When I've got somebody who's just not going to give up. And we've now pivoted 3 times, and we're running out of cash for the 3rd time on a third idea. We're running out of investors. His employees or her employees are leaving, jumping ship, and you're sitting there with them going, maybe there's a better use of your time and energy. Ooh, hospice work is really hard.
It's like landing the plane, and the person's just like, hey, I think I can land this plane. It's like the engines are on fire. Everybody else has just jumped out with parachutes. You're the only person left. And there's a mountain in front of you. Like,
exactly. I think it's a good time for you to live for another day.
I'll stay on the plane with you until we're about 20 feet from that mountain.
I'll take it when I'm leaving.
But I'm going to be out soon.
Exactly.
So what is the best way in your technique to manage the unique personalities who are rule breakers and benders? So we've seen some folks who, Zenefits comes to mind. I was an investor, and I think you guys were in Zenefits.
No, we're in Gusto.
You were in Gusto, perfect. So I was in Zenefits.
Which is still working.
Still working, yes. So to speak, working. We use Gusto, we love it. Zenefits The founder, I think, was addicted to that artificial growth, Y Combinator, and then cheated.
Yeah,
Built
absolutely.
a script so people could cheat or not tell the truth, which feels like cheating to me, on their insurance tests.
Yeah.
And then you have other folks like the Bird Scooters. Are you involved with them? Or in the scooter companies that are dropping scooters on the street without permission or begging for forgiveness or cleaning them up after the fact? How do you look at this new beg for forgiveness rather than ask for permission culture? Where does it cross the line?
I think apology has become a substitute for accountability, and I think that's wrong. I think we hear too many apologies from companies and CEOs and founders all of the time. And I think what they're doing is escaping accountability for having made the decisions and for having gone down those paths and for the results of those things, those decisions. And so I think we need to bring accountability back into the picture. When I work with these entrepreneurs, my job is to set expectations, to measure results, and hold people accountable. And what I hope to do in that process is for them to tell me when they're failing before I have to tell them, because it is all clear.
Yeah.
Right? And so I do think accountability is a substitute, a really important substitute for the apologies that we keep hearing more and more and more in Silicon Valley.
Yeah. We seem to have gone from heroes to villains in a very short period of time. What's your take on all that? Is it the toxicity of the Trump era? Is it just recklessness on the part of Zuckerberg, maybe, or some founders who would just let the chips fall where they may, move fast, break things? What's your take on this?
I think part of it is the power that is now in the leaders in the tech world. I think there's a backlash against, they're not small, cute little companies anymore. Right? They are very dangerous companies because of their scale and their, both from a financial standpoint and also from a user standpoint. So that's part of it. But I will tell you an interesting conversation I had probably about a year and a half ago now. I'm not going to say the name, but he leads one of the tech bureaus for one of the very, very big media companies out there today, a well-known traditional media company. And I was talking about some bad press that one of my companies was getting. And he said to me, you got to understand, this is the tip of the iceberg. This is going to be what the next year and a half look like.
Wow. For that company or for the entire industry?
Entire industry. He said, there's a backlash in middle America, and there's a backlash in the traditional industries against the what's seen as the frivolousness and the lack of maturity in the leadership in the tech world. And so,
is some of that fair, or?
Oh, I think some of it is fair.
Some of it's fair.
But I think the pendulum has moved up. This is not where the pendulum ends. It needs to come back.
It shouldn't be here. We should be somewhere between, lauding them without looking at the details and crucifying them with no chance of any explanation or people to grow.
That's right.
So let's talk about gender diversity in the industry a bit. You guys had a couple of issues in that regard.
Yes.
And it always seemed to me strange because I knew Kleiner as the place where the most women worked. You were way ahead of that curve, but then you had the Ellen Pao trial. And how does Kleiner Perkins reconcile all of that today? Because obviously Ellen didn't win the trial, but obviously some people believe that she should have, and you guys have all seemed to moved on. What lessons do you take from all of it? Because you were there during all of this, and it was very painful for everybody.
It was extremely painful.
Everybody.
It's very painful to be accused wrongly and so publicly in a scandalous way.
Yeah.
And so I can only look at it from that perspective as having been falsely accused as part of this partnership.
Right.
I will say this, the partnership took it very seriously. We took it seriously, not just to the extent that we believe that it was important for us to continue to support women in both as entrepreneurs and as partners, but also to think about, okay, we won the case. We did nothing illegal, but how could we be better?
Sure.
Right? There's still opportunities to be better.
Yeah.
Inclusion goes beyond diversity. And I do think that the notion of inclusion is something that I pay a lot of respect to today, in large coming out of that. Because as I looked at that case, it was clear to me from day one, it wasn't clear to the media, but having lived through it, that case did not have merit. Right. But that didn't mean that the issues that she was raising weren't issues that we should be wrestling with, both as a firm and as a industry.
Yeah.
Right? And they're very real. And they don't just pertain, I mean, women tend to get a lot of the spotlight in this discussion, but it's people of color. Yeah. It's people with different national origins. It's people with physical disabilities. It's people with different gender orientations. These people are not represented.
The representation is horrific in venture capital. Why is that?
Well, it's not just venture capital. It's in the Valley.
Oh, in the Valley, true.
In the Valley,
overall
generally.
in the Valley, but generally, partners, people could sign checks.
Well, I think in the venture capital community, I can only talk about it from the perspective of Kleiner Perkins, and that is we've always made a strong effort to make sure that we have strong women involved, whether it's Beth Seidenberg or Mary Meeker or Julia,
top women in the industry,
incredible women, right? These are incredible women. And by the way, if you don't think that they have important role to play at Kleiner Perkins, you haven't sat in a partner meeting, right? Mary Meeker can beat me into a corner, right? I mean, she's smart as hell. Smart, right? Beth Seidenberg is one of the best investors out there, period. Forget gender. So I do believe that venture capitalists, because they start off as small partnerships, 2-3 people, tended to be friends. They tend to be people that they knew each other.
Right.
And as they became institutions, they also needed to mature. They needed to understand they needed HR, that they need to actually think about diversity inclusion. These weren't natural to 2 or 3 people sitting in a room, getting together 3 times a week trying to figure out whether to invest in a company or not.
Yeah, I think people don't understand the LLC structure and this sort of like partnership. I explained it to people that I think like a lot of these firms are kind of like how a poker game or a book club comes together. It's like your closest friends who may be of the same gender or maybe went to the same school as you. So they're not going to be a diverse pool by definition. Therefore, you start this poker club and there's only 6 seats and the 6 seats stay until somebody dies. And then but now we've seen massive efforts. And you were the most diverse on a gender basis, is that correct?
That's right, absolutely.
So you were the most diverse going into the Ellen Pao trial and situation. But also now you have this Kleiner Perkins Edge where I think you're educating a dozen or so young. Explain what that program is.
Well, I mean, we are working with women entrepreneurs in particular, broadly, and inviting them to participate, even if we haven't invested them. Right. Bringing them into our CEO conferences, exposing them to resources, even if we haven't invested them or somebody else has invested them, because we just think that the Valley is going to be a better, innovative community if it's diverse. There's 3 really good reasons for diversity. One is it's just plain fair. Right? Yeah. Right? It's just plain fair. The other is it's good for business. If you're in the innovation business, you want different points of view. It's hard to manage creative friction, but that's our job. We got to be able to manage creative friction. But the third is also really important. If people like companies like Facebook and Apple are creating the world's platforms.
Yeah, the dominant platforms.
And they're not informed by a diverse group of people, then what we're getting is a homogeneous, pasteurized view of the future that, frankly, we shouldn't accept. We need diversity in that innovation to create solutions that apply everywhere and to everybody.
Yeah, that makes total sense. So the Kleiner Perkins Edge thing, is that like is that sort of like a Scouts program?
Yes.
Yeah, because I know we've had a couple of your partners in that program come to our incubator and give great feedback.
Oh, that's good.
It was a very diverse group of people.
Yeah, I'm glad that's the case.
I think you hired for diversity in that section there and try to get the next generation going.
We're always looking for people who are outside the conventional venture capital mode to come to Kleiner Perkins.
When should a founder reach out to you? What's the right timing? People talk about the timing all the time. When is the right time to pitch?
I'll tell you when I like to be pitched. Yeah. I like to be pitched before you're looking for money.
Wow.
I like to be pitched when you've got an interesting idea and you're looking for advice or feedback, and I can get to know you as a person. I get a sense of your character. I get a sense of your commitment. I get a sense of your purpose. And that, once I've got that and we've got a rapport, then I think we can move towards an investment when it's time.
Perfect. All right. Randy Komisar is the author of Straight Talk for Startups. Stop what you're doing. Go buy the book, buy a second copy, give it to your co-founders, and then every day at lunch, read a couple of them, make it your discussion topics. There's only 100 rules here, so you're going to get through it in a couple of weeks or months, but really great fundamental thinking. And whether your startup is in year 5 or week 5, you're going to get something out of it. There's something in here for everybody, and you can flip through it. Very flippable and very organized. I like it. From one author to another, congratulations.
Thank you so much.
Really well done. Hey, everybody, if you're in town October 10th and 11th, we're having Launch Scale, our conference about growth and growing a company. So we have a dozen speakers there talk about how they built their companies. And if you want more information and you want a free ticket, all the tickets for founders are free, except there are some paid tickets for venture capitalists and corporate types who want to come to the dinners, et cetera. But if you want to get a free founder pass, you can apply at launchscale.net. Launchscale.net/tickets. Launchscale.net/tickets. We give all the tickets, 95% of the tickets at our events, all the ones for founders. We give away for free. Just apply. We check, though. We want to make sure that you're not.
I can't apply, is what you're saying.
Buy a ticket. You got a corporate card. No, it's amazing to me. Like, people email us. I'm like, okay, we're giving away 95% tickets. And then I get like venture capital friends, and I work at Time Warner. I work for IBM. Can I get 4 free tickets for, this company? Not IBM, but other ones like Amazon Web Services. Like, hey, can we get 4 free tickets? I'm like, no, you can buy everybody lunch.
Yeah, right.
But no, you can't have 4 free tickets to go sell into the founders. Like, go buy lunch. What's wrong with you people? Don't you understand how sponsorship works? But seriously, congrats on the book. Straight Talk for Startups. It's out now from Harper Business. Huh? Hollis, great editor.
Isn't she great?
She's an awesome editor. It's like, I think she really understands both the writer and the audience and how to make a good book. So they were like, oh, you're going to use like somebody to help you write it? And I was like, no.
Yeah.
They're like, oh, okay.
Well, you're a writer.
Yeah, I was like, I'm a writer. And she's like, oh, okay. And I was like, I'll just send it to you. And she's like, okay, you want to send me like the first 3 chapters? So I sent her like the first 3 chapters. This is after they bought the book, the first 3 or 4 chapters. And she's like, don't change anything. Keep going. You have a unique voice.
That's great.
Like, thanks, Hollis. She knew like when to tell me like, that's a lot of Jason.
Yeah.
And that's just the right amount of Jason.
She did the same thing to me.
You went full Komisar.
Yeah, exactly. It's like, pull back a little bit from this. By the way, I chose Harper because of her. I could care less about Harper. I care a lot about Hollis.
Yeah, no, great editor. If you're doing a business book and you're lucky enough to work with Hollis over at HarperCollins, we highly recommend it. There's your endorsement. Okay, thanks, Director Tony, for the fidelity of the show of late. Well done, and thank you, Managing Director of Education, Jackie, and the rest of the team here at Lunch. We'll see you next time. Bye-bye.